Right. Yeah. Yeah.
Okay, because I think that somebody told me last night that there was a decent amount of hospitals in that area.
Right.
She get like a lot of traveling nurses going through it too.
Right, Brandon, his wife, he has a couple of units there, his wife, they rent to the, church anywhere. Yeah, only university.
That's the Long Beach and the VAs.
Yeah. Well, there's the,
Right next to Cal State Long Beach.
okay. Yeah. So, yeah, but Long Beach is a big area too, though, university, so. So that's the other, when you say Long Beach, that's the area.
Yeah, well, I'm still wondering there, so I don't know all.
Yeah, that, well, I guess I'm thinking Second Street.
So what's so special about Second Street?
Oh, that's Belmont Shores, right? Is that what you're
Yeah,
talking about?
you have to
All
go
down
to see it,
Shores.
but it's a nice area in Long Beach.
It's the very edge of Long Beach. So it's right next to,
So that's good, you know, but I don't know about the area. I don't know Newport Beach either.
it's the first city or first area once you pass Huntington. So once you get out of the Huntington, you go to Second Street.
Okay.
And that, so it's really close to the Huntington area.
Seal Beach.
It's Seal Beach, yeah, well, yeah. Seal Beach,
All right, guys.
Sunset Beach.
We're gonna get rolling here. So, so we've got people on Zoom, we've got people here in person. Thanks for coming today to the OC Investor Tank. Coming up, probably about another 5 months will be a year doing this. And we've, definitely got a pretty cool group that comes regularly, which is nice. So just a quick little background about myself and why I started this, why I'm doing this. So my background's construction, so I've been in commercial construction for a long time, ever since I was like 16. Went to school, got my engineering degree. I've been doing that. Started investing in real estate in 2016. RJ, what's up, man?
Not much.
Sorry. Yeah, no, you're good. You're good. Glad you came. And went to school with RJ at Cal Poly Pomona here.
How's it going?
So, then fast forward 2016, started investing. Got a friend who really inspired me. He flips probably 20, 30 homes a year. He does really, really, really good for himself. And so that kind of inspired me to, get into it and started out doing it, did well. Still doing my thing to this day. From that point, kind of wanted to learn the financial side of it, the financial markets, right? And how that all works. Because, seeing how people in 2008 didn't see things like that coming. And if they would or knew how it works, would have made a world of difference, right? So that's kind of why I wanted to start it, is because just really kind of showed the different financial indicators like the bond market, the yield curve, so many different things that you can look at that really show you where the system may be going, right? And then after last week, now that we've got some banks going bankrupt, right? SVB Bank, First Republic, their stock is just plummeting. A bunch of the regional banks, obviously those are smaller banks, so they get stressed a little bit easier than the bigger banks. But I mean, just the way the system works, fractional reserve lending, these guys don't have reserves, right? So if there's ever a run in these banks, then they get the hot water because they don't have all that money. They got a bunch of IOUs, but they don't really have the cash. So anyway, so we'll get into that. That's kind of point 9 on the topics here. Yeah, we'll kind of jump right into it. And then we'll kind of come back to this chart here that you're seeing at the bottom. So the first thing I want to show you guys is we do have some good news. So some of you guys are familiar. I've been showing this the past couple times. So this is the interest rate futures. This is basically the 2-year, and that's what the Fed, tracks, and that's how they react based on the 2-year Treasury. Okay. So as economic data has been coming out, kind of get this here for the guys online. So you can see the dates here. So as economic data has been coming out, different things like jobs, inflation reports, what have you, right? These things will adjust and, ebb and flow, right? They're constantly changing. After last week, you can kind of see this 3/10 date here. It's this, line right here. So it was creeping up and getting tighter and tighter. The rates were, basically showing, hey, we're going to stay tighter for longer. And then even when we cut, it's not going to be as much. Well, after we saw some risk in the system, the financial system, the banking system specifically, it dropped a ton. Okay, which is not surprising. Usually you kind of go until, every cycle it's been, okay, something breaks, And then the government's like, oh, shoot, okay, got to go the other way. Right. So that's kind of how it's usually gone. And now we're kind of seeing that. So this is good. So if you are, like myself, not financial advice, but I think right now is a good time to be buying assets. So if you're buying here, right, toward the left, when rates are nice and high, assets are going to get pushed up until 2025, at least until it starts cycling up again right there on the far right. So that's when 2025, you want to start refinancing some properties. You want to be selling risk assets like, stocks, commodities, whatever, depending on, what you prefer. Or you could just take profit, cycle into something else. So anyway, so that's some good news that we do see, based upon all the kind of FUD that I think is out there. I do think people are a little overly bearish right now. Because think about it, we've been bearish for a whole year now, right? Like how long can people be like that before it starts flipping the other way? So
Maybe being on the sidelines.
what's that?
People hate being on the sidelines.
Oh yeah, for sure. Absolutely. Yeah. And then obviously after 22, they got hit. So some people get spooked, pull out and go to a CD or something super safe. And then, and some people, want to get back in. I'm one of those guys. I was shorting the stock market last year, did good. And now I'm ready to go long. So that's my strategy. So this is just some of the things that I'll look at, just the futures. I think it's really powerful to see this, especially when you can kind of see that no matter what's been happening, the general trend is there, right? Oh, and actually, sorry, some housekeeping, forgot to get into this. Next month, we've got a speaker who's actually one of the architects working on my project, my ADU project that I'm doing. So he's going to be talking about R2 and R3 lot developments as well as ADUs, more so on the R2, R3 side. So that's going to be on April 12th. And I had to bump this up. It was in June, but we're actually going to go walk. This is going to be at my property. The meetup will not be here. It'll be at my place there. And we're going to go walk through my new build that's going on right now. So they just got the roof done, stucco and drywall are going to be going up, fairly soon. So that's where it's at right now. So we get to walk a brand new build. So that'll be on Saturday at noon, May 12th. So anyway, just want to make sure people knew since I moved the date. Okay, so you can see here, so this is the 2-year. Now it's been creeping up, obviously, and it's been kind of flatlining. So I've been kind of watching it, knowing that, there's going to come a time where it's going to want to drop. And then, of course, as soon as SVB happens, that's when it just tanks. Monday, it dropped 11%, rebounded about 5-6%, but then dropped another 11% today, actually. So that's definitely good. So again, the Fed tracks this, right? That's all they do. Like a slot car, they just follow the tube. The Fed is not in control. They can micromanage things a little bit and inject money, but they're just going to follow the 2-year, right? And this next chart basically shows it. After looking at this, I'd say, and I've researched this, obviously more than just this chart, but just showing you guys. That's all they do, right? They just follow the 2. So if the 2 is already dropping down heavily, and as soon as it breaks that blue line, that blue trend line, it's going to really start dropping down fast. That means a pause and rate cuts are coming. And that lines up with what we're seeing on the futures chart, and we're starting to see it on the 2 just this week.
Is that dotted line that you have there, is that the projected median point when it's going to start going down?
Dotted line, you're talking. Well, that's just my cursor, the one that's moving around.
The flat line.
Value 4.17, that right there.
Oh no, so that's where it's at currently. Yeah, that just shows where it's at currently. Yeah. So the way candles work is just like the completion of the bar at the very bottom. It's the red candle,
Right.
And then the tails where it went to and touched. And sure enough, right, it went right to about that blue line and touched it.
Went back up.
Yeah. So, in technical analysis, the 200-day moving average, that's what that blue line is. If you're trading a stock, you want to be buying things when it's above it. If you're aggressive, you can buy below, but typically it's bullish when it's above the blue line. And when it breaks below, it's bearish and it's going to start falling pretty heavy. So So that's why I said, as soon as it breaks that trend line, it's gonna start dropping quite a bit. So, and you can just see, if you just go look at different stocks, you can go look at anything, watch that blue trend line, the 200-day moving average, it really reacts big at that. And, you know, a lot of the Wall Street algorithms, you know, trade around that too, so. So anyway, so that's definitely good. So, you know, all the kind of talk from the Fed is, you know, hey, we're gonna go until the job's done. Okay, well, sure, you can say that, but as of this week, we can see new, you know, new data coming out, so, or new events. Okay, got some food there. All right, cool. So on to the 10. So for any of you guys who own real estate, yeah, so for any of you guys who own real estate, this is obviously good. So I've had this kind of doodle projection here for a while. So that's kind of where I think it's going to go. And it's been following it, you know, pretty much to a T. Same thing, we're kind of right on that blue trend line. We're rolling over, you know, a lot faster, just because the 10 is a lot less susceptible to, you know, Fed manipulation. The Fed can really change the 2 a lot, but the 10 is a lot harder for them to micromanage, basically. So this is what mortgage rates are priced off of. Again, it's rolling over. I've got other indicators that I've looked at a bunch of times that we can kind of show you briefly, but let's see. So you can kind of see this like kind of green wave right here. So it's basically a momentum wave. Momentum's a very forward-looking indicator. So you can see when it's red, that's when it was dipping low, and when it's green, that's when it's kind of on its high swing, right? So it's going to come back to the other side. And then, you know, again, you don't have to even just take this chart as proof. You can go back to the futures and follow that too, right? So here is where, you know, just talking with Devin in the room here earlier, you know, in January, a lot of people were getting, you know, mortgage applications. Hey, let's look at real estate because rates have dropped from 7.3 all the way down to like 6.2, you know, basically a whole percent in a short period of time. Kind of bounced up and we're bouncing around now, but eventually it's going to start really ramping down here later in the year, which is good. So that's the good news. So, you know, I really kind of see a bottom, you know, happening. We'll kind of go into some other charts on different stocks. They're all kind of looking the same way, that we've already kind of seen the bottom. Really, on some, June was like the worst. Like some of the semiconductor companies, like I know Warren Buffett was buying, you know, a bunch of the semiconductor companies back in June. He bought, you know, Nubank back in June. That's a Brazilian, basically kind of like banking company. So yeah, a lot bottomed out in June, and then some kind of bottomed out from there until like December. So yeah.
Notice the market ran pretty much all of January.
Mm-hmm.
Is there any
Yeah.
to that?
Yeah, absolutely. So there's something called the January effect. So what happens is coming into December, there's something called tax loss harvesting, right? And so you did have some profits. So you can offset those profits with your losses, right? So a lot of people will do tax loss selling into December. And that way, hey, I had a winning trade here. This one's been a loser forever. I'm going to sell it, but I'm going to rebuy it in January. So that way I get to wash that profit clean, kind of balance out my tax basis, and then I get to rebuy it in January, basically a week later, right? So what happens is selling pressure in December is really heavy sometimes. Not all the time, but it could be sometimes, and it was this year. When all those sellers evaporate and then become buyers or even just sit on the side, now all you have is buyers. So it's called the January effect. You can just Google it, look it up, but that's what happens. And that is what happened. So that's why Tesla went from 105 to 200 in, you know, a short period of time. That's why Bitcoin went from 16K to like, you know, 21 or 22K. I forget the time on that swing. So that's what happened to a lot of different things. It's a good question. So actually, yeah, so that brings me to the next one here. So yeah, funny enough, Bruce was actually here for it, but on 11/9 we did our crypto event, and that was literally the very bottom of the market for Bitcoin. So that was right when FTX came out, and I was like, guys, this is the risk is out, right? I mean, things are risky when you're way up sky high, but if you've been coming down for 12 months, dude, the risk is gone, right? So anyway, but just to kind of show, what we had from so we went from 16 and then we even bounced into February, but yeah, 16 to 23. I mean, that was a hell of a run. I think it's like 45% or something like that. So, but anyway, what I wanted to show you guys here is that Bitcoin is a big leading indicator of just overall, just kind of risk assets, right? So risk assets will be the first to sniff out, buyers, liquidity, whatever, right? So if we compare Bitcoin versus the S&P, you can see Bitcoin actually peaked the very end of November, so right around Thanksgiving. And then the orange line, which is the S&P, peaked at the end of December. So it was telling you a whole month in advance that the market's flipping, right? So some guys actually, and it's not a bad strategy. If you want to just trade the stock market and use some leading indicators, HYG is another kind of leading indicator. That's a bond ETF, which is a junk bond ETF. Bond traders are, pretty dang smart, right? It's called the smart money because there's 4 times the amount of money traded in the bond market compared to the stock market. So when the bond market moves, you pay attention. So Bitcoin, HYG, those are all some kind of leading indicators. And yeah.
Like it decoupled from like the NASDAQ or something. Anytime it was sort of correlated with the stock market. But at some point it started not really following it.
Bitcoin.
Yeah.
I mean,
What caused that? Because I noticed at some point it stopped sort of following whenever there was huge dips. It wasn't.
well, I think it's more just chop more than anything. I mean, if we kind of, from like here to here, right? So like I said, so June was when, a lot of things got really hammered. And actually, if you go to Google Trends, right, you can just type in recession. Google Trends, recession was at its ultimate peak. That was like max fear. That's also when they, said Coinbase is going bankrupt. And, so right around June, it was with like max fear was like out in the market big time. So yeah, like I said, if you go look at NVIDIA or, you're up like 100%. If you bought in June, NVIDIA, or if you bought some of the semis in that time, you're like double your money since then. But you can kind of generally see like from June to here, like look how perfect those peaks line up right there in August. Right, so those peaks line up pretty good. Downtrending all the way to here. Bitcoin obviously is doing the same. Right here it decoupled, but that was FTX. That was when the news on FTX broke. So, but and then you can see right here, same thing, right? January effects, boom. And then now we've kind of retraced a little bit. They've moved pretty much hand in hand. Right. So there's definitely some leading indicators out there. You can kind of do the same thing with Ethereum. As far as tracking as a leading indicator. Oh yeah, absolutely. Yeah, even look at these drops right here, right? Right here, boom, big bounce, and then drop down, and you can just see like how perfect they line up.
Maybe track Bitcoin with the stock market, like the Dow or S&P.
As far as performance,
Doing the same thing with like one of the ETFs.
ETFs, yeah. Well, so the orange line, the orange comparison line is the S&P 500. That is the SPY, yeah.
Oh.
Right, yeah. So that is the SPY. So yeah, typically what I like to do is I'm kind of a swing trader. I like to go long. I like to go short. And what I, kind of try to do is kind of stick to one ETF. So I was trading QQQ, which is the NASDAQ. So the TQQQ, the SQQQ, it's basically you're doing 3x leverage. So if it moves 1%, the leverage one moves 3% in a day. right? If it goes 3%, you got 9% in that day. So, you know, you definitely don't want to go super heavy on position size. I mean, you know, I was at the time, and I was really nailing it. But I was also just watching the screen like a hawk, you know. So now I'm kind of taking more smaller positions, kind of spreading out a little bit, doing kind of longer swings rather than riding it for 3, 5 days. So, and also too, right now is like it's so easy to buy low and just wait, right? So that's kind of more so my strategy, and then just kind of catching some ebbs and flows along the way. Yeah.
I've been looking at those like the TPP and stuff.
Yeah.
Generally, people say, oh, don't get long term into those leverage points.
Right.
But if it's following an index, like if you look at since the start of TPPQ, even with all these down, you'd still be up like 4,000%.
Yeah, no, you will. The drawdowns are just huge, right? Like if you go look at the drawdown that we've had on TQQQ, just because we had so many consecutive weeks of downtrending market, you know, it's the same thing, right? You're going 3x the other way. But you are right. Yeah, if you just held it for the long term, but you know, obviously it depends on your risk tolerance. You know, some people.
Yeah, like this last year was like 80% down, I guess.
Right.
Yeah, people would sell by that.
Yeah, no, exactly. Absolutely.
So I'm curious, did you hold that long at all or no?
No, no. If you're doing the leverage ones, you do not want to hold that long. I mean, like for example,
like crazy, right?
right.
Like since 2010, if you would have held.
So let's go to. So yeah, like right here in, you know, right in August. Yeah, this is right when it rolled over. I was probably in this for about what we had. How many days? 1, 2. I probably really got in right about here. I only rode it for about 3 days. So once I saw the move kind of exhaust, you know, I was only in it for about 3 days right here, right? Then it had a green candle, kind of bounced up a little bit. I think I caught a little bit of this move and then a little bit of this one, right? But for me, I was like, okay, cool. I'm going short and it's just getting, you know, my funds for going long bigger along the way. So I would definitely, you know, implore you guys if you can to really get comfortable with going short. Just even start with something small, start with $1,000 or $100 or whatever it is, and just get good at it, right? And the chart's just reverse. So the chart is definitely like flips. So if you're kind of used to looking at technicals or charts a little bit, that'll help. For me, I like to look at just the pure ETF and know when it's going to kind of roll over. And I've got different indicators, you know, on that. So if you go to my YouTube channel, my whole setup and how I look at indicators is all there. So if you guys ever want to check it out. I had another point I was going to make as far as leading indicators, but that'll pop in my head in here in a minute. So yeah, so anyway, so like I said, HYG, Bitcoin, you know, Bitcoin, Ethereum, basically all cryptos kind of trade together. You know, again, those are risk assets, right? Those are kind of leading indicators, and there's, you know, AI stocks. Those are all, you know, could be popping before the S&P does. So definitely a good thing to look at. So HYG, if you're traditionally just want to look at the stock market, that's one you want to look at. Okay, cool. So one thing I kind of want to take a look at is just the bond market. So this is why we've kind of got a lot of risk in the system right now. Or, you know, we had such a fast, quick drawdown is basically a ton of money flew out of bonds, right? So again, like I mentioned, the amount of money in the bond market is 4 times that of the stock market. It's huge, massive. So when you have a 40, I think it's like a 46% drawdown in the TLT, this is one of the biggest bond ETFs out there. So when you go out of that trend line that it's been trading in since, you know, back in previous to 2008, I mean, that's huge. So that's why the rates, you know, jumped so much, because that money flew out of bonds, and bonds have an inverse relationship on rates. When bonds go down, rates go up. When rates go down, bonds go up. So that's why a lot of safe money goes there, because rates, they're fairly easy to predict, right? So it's not an exact science, but if you catch the greater trend, it's not so bad. So So yeah, so that's why a lot of money is kind of on the sidelines, and it's, you know, flying to gold, it's flying to equities, it's going to real estate, you know, it's kind of been unlocked from the bond market. So, and that's going to kind of have a drag for a good while, for probably about, you know, they're kind of saying about a good decade. You know, because once money comes back to the bond market, then things will stabilize, you know, and then you'll have another bull market like we did from, you know, 2008 to now. But because of this, growth's going to be a little bit tough again. So you got to kind of place your bets wisely, have exposure to gold. I'd recommend. Gold's definitely really cheap right now in relation to, you know, other things. You have a question or
No.
no? Okay. So yeah, like I said, this is TLT, one of the biggest bond ETFs. And that definitely adds to kind of the risk that we're seeing in the environment. So the Dow to gold ratio. So again, I mentioned gold. This is, you know, definitely something you want to look at as far as, you know, adding it to a portfolio. If you want to have physical, maybe a good idea for reasons we'll get into later with bank bail-ins. But here's some kind of just technical analysis on the Dow to gold ratio. So basically, if you are buying equities at the bottom of this trend, okay, and this is just a relationship of the value divided by the value of those two assets, okay? So if you're buying at the bottom here, stocks are cheap. If you're buying gold at the top here, gold is really cheap. So, and then kind of down here in my YouTube video, you can kind of see the cycles, right? So this is the S&P. If you were selling out here and buying gold, then you caught this huge rip on gold. And then if you sold out here and then bought stocks, you caught this huge rip on stocks, right? So that's what this ratio kind of helps you see and shows you is, okay, what asset do I want to be in? Do I want to be more gold heavy or precious metals or commodities? You know, so that's definitely a good play right now to, you know, add your portfolio if you're, again, self-managing like you are. That's something to consider, right? So I do have, you know, my own personal piggy bank of physical metals, some gold mining stocks. You know, it's not a bad thing to have. So just know this is a tool that's out there. Dow to gold ratio. It's been looked at for a long time. You can kind of see these trend lines. It's been respecting that relationship quite well. So if we're looking at this right, gold is going to outperform as it drops down this way. Gold is going to outperform the S&P. So, and I would definitely kind of agree with the relationship that we're seeing here. I do think that the S&P is going to underperform, you know, for this next decade compared to what it's done in the past decade.
Feel that's true for a lot of things like real estate. You think we hit an area of,
Well,
we made a lot of money now. And
yeah.
we've got it.
Yeah.
It may be a while before it happens again.
Well, so I mean, I think we will go up in value from A to B, right, for the next, you know, let's say to 2030, but it won't be on the same scale of growth. Yeah. You know, definitely, especially what I see, you know, in my day job, right? So construction materials have gone through the roof. Commodities have been really cheap for a long time. And, you know, now commodities, I mean, they're, you know, that's, again, if you want a good, solid, just set it and forget it investment, put it in a commodities ETF. You know, wood, lumber, oil, all that stuff is going to rise like crazy. It already has. It actually way outperformed the S&P from 2020 to now. So,
You know, about gas.
right, yeah, I know, when it was like negative, right? When they were,
at home.
yeah. Yeah, so I mean, you know, for real estate, I would definitely say, right, like everything's gonna get more expensive. So in my job, pre-pandemic, things are 32% more expensive. Right, and that's not because I'm a greedy contractor. That's because that's how much it costs, right? Like you've had some retirees, and so, you know, labor's a little bit, you know, harder to get. So you got to pay people more. So it's a little more expensive on labor. Materials are, you know, harder to get. You know, like getting wood doors takes like 18 weeks for us. It's crazy, you know? So, yeah. So, yeah, we're definitely seeing a lot longer lead times. Material prices are through the roof. To get a generator, you know, if your facility's got a generator, it takes a year. So, like, we have to get in the queue early to get that stuff. So that's kind of what we see on our end. But, you know, then, knowing what I know about the financial markets, again, commodities are going to be a super safe play as we kind of de-globalize, because we've had a lot of good, easy, free trade for a long time. Now that people are kind of getting a little, war happy, now we're kind of de-globalizing and trade isn't flowing as freely as it was. So that's also another driving factor. Okay, cool. So this is the yield curve chart. So this one looks a little spooky, right? So when you, right here where my cursor's at, so that's the gray line. So that's kind of the zero marker. So basically what this is, we were looking at this before, is the relationship of the 2-year versus the 10, okay? So this is the treasury market. And when the 2-year is paying more than the 10-year, so basically you park your money with the government for 2 years versus 10. And when the 2-year is paying more on interest than the 10, that's basically a huge signal showing that you've got a recession coming, rates are way out of whack. It's basically one of those two things, right? And so you can see every time we kind of cross below that zero line where all those yellow lines are at, we've had a big kind of meltdown in the market. So, and we've seen kind of a really controlled sell-off, but we're really inverted right now. I mean, we're more inverted than we were in the 80s. I think actually at the same scale, basically.
And the blue
So-
is the 10.
I'm sorry?
The blue line is a 10.
That's the ratio again. So that's another ratio, right? Yeah. So when you're shooting up and you're rising and even descending, it's not so bad. And once you cross that zero marker, once you go negative and the 2 is paying more than the 10, now it's kind of a warning sign. So it's now that what we saw and what I showed you guys with the 2, you can see this huge spike, right? Because now the 2 is kind of correcting a little bit. So, but anyway, you can kind of just see it time and time again. It always happens. So when you get the yield curve inverted, if you guys ever watch, stuff on MSNBC or whatever, even Jim Cramer, if they're talking about the yield curve, right? This is what they're looking at. All right, cool. So kind of want to show you guys, what I talked about when I'm kind of, seeing a lot of things bottoming. So we've kind of got a somewhat mixed picture, right? So we do have some good things going on in the rates. Typically they already start dropping for, a little while before things bottom. I think this time could be slightly different because of the rate of how fast the rates went up. It kind of already shook things out a little quicker. So if we just kind of look at some general charts, so even just some of the things that, I like to look at or things that I'm investing in, again, not financial advice, but this is Kathy Wood's ETF. So this is ARK. Again, you can kind of see that June was kind of, basically the low, and we've kind of been just kind of bouncing around, right? So that blue 200-day moving average is getting closer and closer, which is a really good sign. We're not too far away from it. We've got a pretty good trend line here at the COVID low right there at 2020. So if you're looking at, this is Tesla, this is Teladoc, this is like a basket of 50 different stocks that are all pretty good sized companies, right? They're not small at all. And then some of them are definitely, kind of, I'd say companies for an emerging market, right? So like Teladoc is telehealth. You can talk to a doctor virtually, right? And so I think a lot more people are doing stuff like that, rather than, taking time out of their day to drive down the doctor's office. So
Stocks are in there.
it's about 50.
Those
Yeah.
stocks.
Yeah. So yeah, it's pretty small management fees. So as far as, I'd say again, another set and forget thing, when anytime you see, huge, crazy vertical moves into this, you want to take a little bit of money at the table, right? So this is where people got real hypey. And actually this chart fits perfect, right? So this cycle that I'm going to show you guys. Okay, so it's kind of 4 phases to a market cycle. Let's see, here we go. So accumulation, markup, distribution, where you kind of go flat, and then markdown, right? So what do we see like almost to a T in the chart, right? We see that four period cycle. So, and if you kind of look at various different assets, you're kind of seeing that across the board.
So familiar with those four terms, cycle, can you define what they mean?
Right. So when you got the accumulation, so this would be accumulation right here. Whoops. So from here to here, I mean, you trended up, but you somewhat went sideways because you 1, 2, even almost 2, 3, 4 times, hitting the trend line, kind of going sideways. So this is accumulation. So this is where enough people were buying it, and then before it finally lit up and took off, right? Obviously, a lot of money injection happened at that point too.
And it went up because more people bought it, or it went up because?
Oh, yeah.
Doing a better job?
Oh yeah, no, it went up because more people bought it. Yeah, so
Didn't slide.
2020 happened, right? And money got super cheap. People got stimulus checks of $1,500, and they could buy the ETF or they could buy a super out of the money call option, So, so retail definitely participated big time in 2020 in the markets. And then of course hedge funds and everybody did, right? So.
How do the indexes compare to like this? So was there a reason you showed this specifically this one or just?
So this one is kind of risk assets again, right? So I'm a little more aggressive in my investing. I kind of like to go for things that, kind of move and shake a lot. I'm not so much of like an S&P investor or a bond investor. Those move a little bit too slow for me, especially if you're looking at short-term trades. But now that things have really shooken out, these are looking really attractive, right? So when you go from, trough to peak, I mean, you're down 77%. I mean, again, is it risky when it's, all the way at its peak? I'm sorry, is it less risky when it's all the way at its peak? Heck no, it's way more risky when it's at its peak. All the risk is out, right? So whether it goes down another 5% or whatever, it's like the odds are kind of on your side, based on also what we're seeing with other indicators that it's gonna want to flip the other way. So, so again, ARK, 10% of this is Tesla. Tesla obviously did really well, and I think will continue to do really well. And Coinbase, you can you just go to Yahoo Finance, type in holdings on any ETF. It'll show you the breakdown and the allocation to each company.
I think Tesla drove a lot of that because I think it was the biggest holding in that fund or something.
Yeah, no, it is the biggest holding in this fund. Yeah, but it's still 10%. I mean, it's sizable, but you obviously have to have everything else perform pretty good too. So, yeah, another one that I am accumulating quite a bit of is Coinbase. So this happens, quite often. A lot of companies will IPO when things are real great and gravy, and it's like Rivian, Coinbase, and so a lot of people are kind of just like not even thinking about these things because Coinbase went from 400 and now it's, down at its low, it was at like 35. And I was lucky enough to get some shares down here. But, again, we're kind of seeing the same thing. June was kind of the ultimate low. We're kind of just chopping sideways here. 200-day moving average is getting nice and close. As soon as it is able to break that, get some strength and break that 200-day moving average, the whole dynamic changes.
That's some of the Chinese stuff. Those things crash like
Yeah, bigger. Yeah. I mean, I don't know if you're familiar with Ray Dalio's book, The Changing World Order. Let's see if I can get so Ray Dalio is, let's see, hopefully I can find it. Ray Dalio is one of the biggest hedge fund managers in the world. This is kind of it, basically. Yeah, here you go. So if you can see that good enough. So you've got the Dutch Empire. Okay. And so typically what it's saying is, hey, this is kind of a theory type thing, but it's happened enough times in history to where, he's got a theory behind it. Typically empires are strong and really robust for 250 years. And then the baton gets passed. And so the Dutch Empire was strong for about 250 years. And then it was the English Empire, right? And then it was the United States in 1776. Fast forward, I think we're at 244 years, 250 years, we're coming up on as the US as a country. And so he's saying that China is going to be no surprise, the next kind of superpower to take on that next 250-year cycle. So yeah, I would say, if you're looking at a 20-year time horizon or you're in a 10-year time horizon, yeah, I think they're going to do really good for sure. So I think just like anything, you want to place your bets carefully, but even if you did a very generic blended Chinese ETF, you'd probably do pretty good. The Hang Seng, yeah. Yeah, I forget the ticker, but I know. Yeah, the Hang Seng, I think is like, it's kind of the S&P 500 of China. So, okay, so let's look at some more. So again, Coinbase, ARK, again, these are all things that I own and I look at. Let's see, let's even look at Alibaba. Same thing, May, June, kind of the low, chopping sideways. We kind of already made a little bit of a breakout over the 200-day, but we've kind of, retracted a little bit. So these are kind of just some indicators of relative strength index, and this is my market cipher indicator. Again, you can.
What was it at its all-time high?
All-time high, Alibaba. Yeah, it looks like we were looking at 313. So yeah, I mean 313. What is that? Again, 73% drop. So that's kind of what you're seeing across the board, right? So everything's like 70, 80, 90% down. All the risk is out, right? So that's why I'm saying pick things up, because how could it get any worse? So that'd be pretty incredible if it did. I can't see it. It'll be
Plus it crossed those 200-day average.
right. We crossed the 200-day average. We're coming in, pretty close into an environment where rates are flipping. Now that we've seen a couple of companies, pop, especially in the banking sector, which you really don't want. Now things are going to change, pretty quick. Let's see. Here's another one. DApp. This kind of tracks a lot of different blockchain-based companies. Some of the Bitcoin miners, Coinbase. Silvergate was actually one of those companies. Really small allocation though, Silvergate in this ETF. Silvergate went bankrupt, if you guys don't know, but kind of the same thing. We're down from the high all the way. Things are getting in the way. Yeah, about 83, 84%. So Tesla, kind of the same thing. Right there in January, that's where it kind of made its big bottom. Same thing, kind of low in June, but even kept going down further. So I think, Tesla's probably going to just range a little bit, like right, kind of right in this region right here. It may kind of ping pong around back and forth a little bit.
Need to have Elon Musk says with that chart.
Yeah, right. Yeah, so I mean, if you kind of look at it's kind of following a little bit of the same thing, right? Accumulation, markup, distribution, markdown. It's kind of already gone through that cycle. Like this would kind of be accumulation back here, huge, massive markup, and then markdown, and then I think we're going to kind of maybe chop sideways a little bit, but eventually we're going to have a run out of there. So, but yeah, just I mean, here to here, I mean, these are monstrous swings. So if you are going to look at it in this channel, you don't want to be buying it.
Difficult because
Right. I mean, you may have a breakout, right? I mean, if it breaks that trend line, you may have a breakout, but just be careful that you're accumulating at a smart level. I think it could probably, it's already kind of wanting to bounce here. It may kind of chatter a little bit and then eventually catch its legs and, want to go up from there. So, and then just to kind of look over at some of the cryptos, you're kind of seeing a little bit of the same thing, right? So, again, accumulation, markup, markdown, and now you're basing out. So, and this is kind of across the board. So
what happens from there? I mean, we done the chart.
So from there, you start another cycle.
Oh, okay, just
So you start another accumulation phase, then you have a markup phase, distribution where you want to be selling. And now that you guys know this stuff, you'll be smart enough to want to sell into that, right? And then wait for the markdown or go short at that point.
Interesting.
So if you're aggressive, you can go short. If you are not aggressive, you can go to a safety asset like gold or just sit in cash. Even cash is, as the American dollar, that is definitely a safety asset. If you were in, the Turkish lira or, some other, currency that has collapsed recently, obviously it's not, right? So yeah, that's just some of the things that I'm looking at and watching. So, and then definitely after what we've seen last week, with SVB and some of the smaller banks now, becoming more risky. First Republic, they've got a location right here in Newport. They're definitely not a small bank by any means, but in the grand scheme of things, they're smaller than, the major primary dealers, Chase, Wells Fargo, Bank of America. So I don't know if you guys have heard of bank bail-ins, but what is happening with SVB is, I think, is basically going to be a bail-in. So in 2008, we did bailouts. Bail out means money from outside is coming in and making people whole, right? They're taking a bankrupt entity, making it not bankrupt because the government injects money. Well, after that period of time, where we at? Okay, here we go. So after that period of time, some of the larger central banks got together. So if you guys know who the IMF is, the International Monetary Fund, going back to this kind of food pyramid here. So this is kind of the structure, right? So the IMF is here at the second to last, tier. And then from there, you got the BIS. There's the World Central Bank. Okay. Those are the guys who really call every shot that you could, possibly think of as the BIS. But the IMF is obviously pretty well up there. So the IMF basically said, okay, now that we have this problem in the banking system, we can't do a bailout again. But the next time it's going to be a bail-in. Bail-in means depositors do not get their money out.
They just said this when all of the deposits are being made 100% whole.
Okay, and is that with FDIC insurance?
No, the government, they're paying 100% of everybody's getting their money.
Right.
They're using the shareholders, if they're taking them down to zero and giving all the depositors some money.
Okay, it hasn't happened yet. So I would say if you're going to take down the rich guys basically and make all the little people whole, not many things work that way. Usually the big guys always, come out on top.
The stock's basically zero.
Right.
There is no.
Right. Yeah. So anyway, so this is, look at the date there, April 24th, 2012. So the IMF made this long time ago that this was going to be, the next step. When the banks go insolvent, there'd be a bail-in. So I don't know if you guys saw what happened in China. There was a bail-in in China. You guys can kind of go look at it a little bit. They were protesting in front of banks. Happened in, Lebanon, same thing. They had a bail-in. Cyprus had a bail-in in 2014, a long time ago. But Lebanon and China happened pretty recently. So once I started to see that happen last year, and knowing this information I've already known for a while, I'm like, okay, wow, this could happen like pretty soon. So that's why I wanted to show you guys now that we've really seen it hit, on US soil especially. So one thing that I've been doing to protect myself against this, so I think all US depositors and banks today, it's like $24 trillion. The FDIC insurance is up to $250,000 per bank account, right? Well, out of that 24 trillion, they can only cover 1.6%. And SVB alone was right at that number. So that's why I said, is that for FDIC or, right? So I know
that the government said they already come out and said that they're gonna 100% all deposits.
I know. And the reason why they're doing that is because all of a sudden, if you get a bank run, everyone starts running the bank, pulling money out, the whole system's screwed, right?
I think
That's
Biden
interesting.
said they weren't bailing out.
Well,
But then also the FDIC only has $200 billion in tag with $100 billion in credits. They don't have $300 billion. You can't insure $24 trillion.
Exactly. That's what I'm
That's
getting.
why it's a dangerous precedent, because if they're gonna bail out this bank, when it happens to the next one, they won't be able to do it.
Right,
It's just-
exactly, yeah. In 2008, the FDIC insurance almost went bust. It's at its wit's end.
That's what's gonna happen here.
Right, so knowing that, with these big swings in just economic cycles, right? When rates go up a ton, banks struggle because for a long period of time, no one's getting loans, and that's how they make their money. And plus, people are saving, and when they save cash at the bank, it's actually a liability to the bank to hold cash. They need bonds, they need treasuries, they need mortgage-backed securities, right? Those are assets. Cash is a liability to the bank. That's just kind of how it shows on their accounting balance sheets. So anyway, so that's kind of where, set the stage. That's kind of where we're at. And again, you can go look at those other countries where this has already happened. And we'll see what happens with SVB. I really think it's going to be a bailout. I really don't think those people are going to get made whole.
Yeah, so on the Washington Post, the government has made an exception for SVB and it's going to make agree to make all the depositors whole. Washington Post. I mean, unless they change their minds, they don't do it anyways.
Yeah. Until it happens, right? I mean, they can talk all they want, but we'll see what happens out of it. So, so one thing you can do, and I've been doing, is just keeping what I really need for bills and necessities in my bank account. Stock brokerages, they're not going to mess with those, right? Wall Street loves people trading money because it's kind of like a big vacuum for them, right? Like the average retail investor they're not really good at trading. So they got to take advantage of that, along with Jim Cramer, guys like Jim Cramer. So if you keep it in an investment account, they're not going to mess with that. That's where the rich keep their assets. Nothing's going to happen there, right?
Still hard assets and technically, I mean,
Technically,
yeah.
Technically, if you do read the fine print on the stock brokerage account, the ownership gets a little fuzzy. Yeah, so that's a whole different rabbit hole, but so that's what I'm doing. So I'm putting the majority of my money into a stock brokerage, which I already want anyway, because I want my money to work for me. And then just keeping kind of bare necessities in the bank account, right? So that's something you can do. You don't have to do that. I advise you to kind of look into this, kind of think about it. But now that it's already happened as of last week, I would pay attention to it a little bit. So yeah, it's pretty interesting, but it's crazy times that we're in, So yeah, again, so the IMF, that's the level that they are at, right? So they're above the Federal Reserve. So, and then from there goes the BIS and it stops there. So, if we ever do have a one world currency, it'll be through the BIS. So, cool.
Things like CDs insured only through the bank you bought it through, I guess. Is that part of?
Well, CDs they're basically kind of, yeah, it's basically through the bank, right?
Okay.
So they're taking that money and they're giving you a return and they're doing their own investments with it.
So you have to look at who owns that CD.
Yeah.
To find whether it's your $250,000.
Yeah, right. Yeah, so yeah, if you guys ever have any friends that have been, gold bugs or whatever, right, after 2008, I mean, that's why they are the way they are, is because they've been, kind of like, hey, like this could happen one day. So, so anyway, I think it definitely deserves some thought and some looking into. You can go read about it more. This is actually a gold site called SD Bullion, but just type in SD Bullion bank bail-in, and then this will pop right up. But I mean, this is right on the IMF website. I mean, you can go find the PDF and read all through it, talk about it out in the open. It's definitely not, a secret. So they just don't televise it. They don't really throw it out to the masses. So anyway, so that's kind of some of the things that I've been seeing, some of the things that I've been looking at. I think it's really cool to get a clear picture when you can really see, charts and data points like that. And also when you can kind of look across the whole market and kind of see a big trend going on, right? So I think right now is a really low risk entry into a lot of different things. Real estate could go down a little bit more from here, but rates are going to support it eventually. So, and you got so many people working from home. I mean, that trend is not going away. Like New York office buildings, I think like only 15% of companies are going back to the office. So actually a lot of, office tower owners, commercial real estate, office buildings are not doing so good in New York. So
we're seeing a huge increase in Richmond, down from Richmond, about 2 hours south of DC. And we're seeing a lot of people from New York and DC move down to Richmond. Right. Richmond is so much cheaper than New York. Oh, yeah. And they're coming down and paying straight all cash for houses and properties like it's not.
Yeah. Right.
They don't have to be in the buildings anymore.
Right.
And I used to work for Capital One. It's about a year and a half ago, and one building we were in, as soon as COVID hit, they sent us home. They didn't renew the lease, and they sold one of their buildings that they had, $100 million of sold it for. But they got rid of the office buildings immediately.
Right. Yeah. Yeah. So, I mean, I don't think that trend's going away. I think, I mean, even, people that I know, they're like, hey, I'm not taking a job unless I can work. I'm like, that's, I'm not going to do it. Right. So I think that'll keep going. So obviously that's going to prop up residential and really, help that market, and it already has. So I think commercial real estate, we're going to see a bigger hit in commercial real estate this time around more than anything. So.
So as a builder, you need to convert commercial into residential.
Yeah, that's right. I know.
So,
Yeah.
they've already done it with the old, at least for where I live, a bunch of old factories from like the
Mhm.
1890s or old 1900s. They started converting those over to like loft apartments and stuff like that.
Wow.
So you'll see the same thing commercial. It's just that the price has to come down low enough
Right.
for it to make business sense to go in there and do it,
And that commercial price tag to it, yeah.
Yeah, no, absolutely. I mean, you're definitely seeing some like office buildings getting converted to multifamily. I can kind of see some things down the pipeline a little bit before, some other people. So kind of seeing some stuff like that, which is pretty interesting. But I mean, it makes sense, right? Old malls that aren't getting used. It's like, what do you do with them?
Well, I heard that Spears here at South Coast was gonna be turned into residential, but. I
Yeah,
don't know if that's gonna happen.
I think California's really, I'm sure they're gonna loosen the building code a little bit to, because I mean, we need housing, right? That's why they started ADUs back in 2016. It's like, if you're not getting enough, then you gotta make some kind of move to help
Now,
push
I'm
it along.
curious on the local market of the ADUs. Have they slowed that down around here? Because I know a lot of people leaving California as a population.
No, it's getting easier and easier every year.
Okay, but I'm saying like, I just feel like looking at population trends, like a lot of people are leaving California as a whole.
Yeah.
So I wonder.
But
it's some things up.
It's still a drop in the bucket. So
It's a small percentage.
yeah.
There are a lot, number of people,
A lot of people.
But- yeah. So
Yeah.
there's-
A lot of available properties.
Yeah, so I think last year, it was either 2021 or last year that we actually did see a net negative, outflow of people.
Yeah.
But it was really small. It was like, not that many people that actually left California. Because, traditionally it's like, yeah, you got some people leaving, but they're not coming in. It's just, outside.
We lost the congressional district. It's sizable.
Well, but those people are going elsewhere, right? And those are getting bigger. So even though we're not, the population grows as well, so I don't know the, specifics on that, but again,
We lost the congressional district.
But it's saying that
For 150 years, California lost.
right, yeah, no, that's big for sure, absolutely. Yeah, I mean, if, compared to Texas and Florida and Nevada, it's like, yeah, if you want to save a lot of money on taxes, why wouldn't you?
We're just moving out east again too.
Right.
Those are getting more expensive.
Yep. So. Yeah, so it's interesting, definitely, course opportunities, out there, so. But yeah, next meeting, we'll talk about, lot developments as far as R2, R3, that's, selfishly, I get to kind of pick the topics and things that I'm looking at doing, so that's kind of, something I want to get into, and, hopefully it's very informative for you guys. So. Cool. Yeah, any other questions, guys? Nope. Cool. All right, cool. So we'll go ahead and break. Thanks everybody online for joining. This will get posted to the YouTube channel if you ever want to go back and watch it or share it with anybody. And we will see you guys here next month, same time. And then don't forget, the May meeting is not here. It'll be. All righty. Thanks, guys.
Thanks, Tom.